I have questions about rates. And what I do is I call my longtime friend, Tony Blodgett. We've known each other since high school. He's the EVP of New American Funding, mortgage lender extraordinaire, running the machine, the genius, the mad scientist. So, Tony, like this is boggling my mind. So we were texting about this. I'm like, you know what? Let's just go record it.
Yeah.
So rates were going down towards the Fed cut. Then the Fed cuts and rates go up. What happened? Did I miss the memo? Like, what's going on, brother man?
Well, it is really confusing, and I'm happy to pop up a chart here and just show you how drastic rates have moved since the Fed rate cut. You know, a couple things that I would say. First of all, it's not abnormal for interest rates to go up after a Fed rate cut. Matter of fact, it's happened in the last 3 cycles. So this isn't like a crazy idea that this would happen. I think there's some underlying factors here that I'll get to in a second. But one thing I think it's really important to understand about the Fed is that, you know, you think way back, like before, like say Alan Greenspan, who everyone knows who Alan Greenspan is because he was like the first like famous Fed chair, right? I mean, the guy loved to be in the limelight and talk about what's going on. And it was really back during those times when you started having, you know, even a press conference after a Fed rate announcement. And so what I'm getting at, Anton, is there's been a massive amount of transparency that's been put into the Fed and at a level that we've never seen before. Matter of fact, they have moles now who kind of whisper out the numbers on what's going to happen with the Fed before they even do it, you know? So there's no surprise if it was 25 or 50, they hinted at the 50. Everyone's like, oh my God, this is such a big surprise. Well, not if you're listening to the moles, and these are known moles. This isn't like a secret thing.
Like Nick T over at the Wall Street Journal. He seems to definitely be one of their friends.
Absolutely. And it's intentional. It's because they don't want crazy market reaction. But all this transparency has led to a situation where the market, you know, all the Fed rate cuts that could happen this year, Anton, were priced into the market well before the first one happened. And so that's a big part of what we're seeing is, you know, for a while there, we thought there'd be 6 Fed rate cuts, you know, or even 7. And this was before the Fed even made their first rate cut, which they did on September 18th. And so, you know, they moved 50 basis points. It was more than people thought. But they also cued into the fact that, you know, there's probably not going to be 6 or 7 Fed rate cuts by the end of the year. The dot plot doesn't show there's going to be that much Fed movement. And so we actually had to unwind some of the anticipation that happened. So rates did improve. Here's the I guess the good news is mortgage rates improved significantly more than they should have based on the data leading up to the Fed rate cut. And so now we're giving some of that back. But I think there's some other factors going on. But does that make sense? That kind of first part?
Yeah. So the market was pre-pricing in, and that's what got us towards the low 6s, because markets are forward-looking indicators, right? So they're betting on what they believe the future is, and they believed, you know, possibly 6 cuts. So they're betting it's going to happen. And then it happens, it shot up, but I feel like it came up more than it was supposed to. So then what happened? Why did it trough so high or peak so high?
Yeah, well, it's the data, right? And we all know that the Fed's looking at the data. And right after the Fed rate cut, we got some jobs. The first move, you know, inflation still improving, but not as drastic as it was. You know, we saw some jobs reports that came out that were very strong. Some revisions, the previous job reports that, you know, were strong. So, you know, the jobs data, I mean, and honestly, if all the jobs data we have today, meaning the jobs report that came out the 1st of October, if all that was in hand, you may not have seen the Fed do what they did at the end of September, to be honest with you, because some pretty strong jobs numbers came out. So it just makes people wonder, okay, what's the Fed going to do now? The other thing we've seen is retail sales still very strong.
Yeah.
Just today, we had, now I'll hold on the JOLTS report for a second, but, you know, consumer confidence way overshot expectations, right? So, but now what we're starting to see, I wonder is, and I talked about this on a podcast, when there starts to become certainty around the election, but we went from the situation, and this is not political, This is just that people have an anticipation of what one presidency will do versus the other. And after that debate with Biden and things look really solid towards Trump, you saw the markets react as if, okay, Trump's got this. And then, and I talked about this on a podcast, certainty, the markets like certainty. Well, then this period of time came where, Biden's out, Kamala's in. Now, all of a sudden, it's looking like a very, very close race. We've seen a lot of uncertainty in the market. And now it's starting to feel like the polls are all showing that, Trump has a lead and many people are anticipating that he wins. And so I'm wondering if part of what we're seeing here in this last week is a little bit more trading based on, again, like you said, future anticipation that this is going to go one way. Now, you might think, well, look, Trump stands up there and says, I'm going to lower rates and I'm going to, do all this stuff. So why wouldn't rates be getting better with Trump? Well, it's because there's other investments that people think will do well under a Trump administration, and the dollars are more than likely moving there. Look at Bitcoin in the last, if you're a crypto guy, look at Bitcoin in the last few days. Look at gold prices, all-time high. The anticipation of the stock market, where it's going to be over the next 12 months is as high, came out today, as high as it's ever been. So lots of people thinking, bullish on Bitcoin, bullish on gold, bullish on the stock market. And so that's got to be sucking some dollars that otherwise would have been invested into bonds, generally speaking, but more specifically mortgage-backed securities. Also, you still have a very high 10-year yield. So think about this. If you're an investor, are you going to be buying 10-year treasuries or are you going to buy mortgage-backed securities? They're both kind of the same thing. Still get a pretty high return on your treasury, but it's 100% guaranteed by the federal government. Keep in mind, in years past, we had a Federal Reserve not just with a very loose monetary policy with very rates close to zero. They were buying not just treasuries, but they were buying mortgage-backed securities. They are not buying them. I don't know if they're buying any right now. Matter of fact, they're selling off their balance sheet. And so those have to be sopped up by somebody. And then you give this competing assets to invest in, right? And that's really hurting us right now. And that's why it's, in my opinion, gone to the levels that it has. Do you want me to show you a chart really quick? Can I do that?
Oh, I'd love to see a chart. And as you pull that up, I've read about this and I've seen other things about this. People are calling it like the Trump trade. It's this idea that there appears to be certainty in the market, and some of his policies appear to be inflationary, possibly tariffs, things of that nature. So the market is pricing in higher rates right now because of that certainty. Now, if something changes here in the election over the next couple of days, some of that certainty could go away, rates could go down. But the thing I want all of our listeners to get, and these are conversations Tony and I have all the time, the market is always trying to look into the future. They're always betting on what they think is coming towards us, not what necessarily is actually happening in that moment.
All right. So what you're seeing here on the screen, this is MBS Highway. This is one of the services that we use in the mortgage business to track mortgage bonds. Now, what's interesting about today, you see, we're actually up 22 basis points today. Green is good in this world, but down is bad. Okay, so this is mortgage rates getting worse. It's an inverse of what you would expect. You might expect it to be going up, but down is bad for mortgage rates. Now today, I mentioned that JOLTS report. So I don't know exactly what the market's reacting to here. The JOLTS report did not come in anywhere close to the BLS jobs report that we got last week. Matter of fact, it was much stronger. And in some ways, it was completely contradictory, Anton, what we're seeing with the JOLTS report. So initially, bonds were down this morning, and they have all recovered. If you look at this, we can see how much they recovered since this morning. So we're up 22 on the day, but we were down when this report first came out. And then all of a sudden, not only did we make up those losses, we've made some significant gains. So we're up 47, 43 basis points since this morning when rates came out. And part of that, I have to believe, is the JOLTS report, which kind of comes from the same data, supposedly, is very different than the BLS jobs number and is actually showing quite a bit of weakness in the employment numbers. And it's just so bizarre. I mean, there was like an $807,000 job discrepancy in government jobs between the two
Yeah.
reports. It just literally doesn't make any sense. But the BLS numbers, the household survey, is what goes into the unemployment number, which is why it ticked up just a hair. No one liked that. So, but this is how much we've moved. This is back here, September 18th is right there. And you can see that it's really just, been going worse since then.
And so at what point do, and I'm not a bond trader, but at one point do you look at that and you go, it might be time to short the 10 because it's going to top out and make some money as it turns the other way? Or is there like a moving average or something that you're looking at that kind of shows, hey, this is going to change direction?
Well, I don't know if you looked at that chart, but I could pull it back up.
Yeah,
What
pull it back up.
What you would see is that we might actually today might be the day. Today might be the day.
Oh, got it.
Turns. Well, I'll show you why I say that. So you see this line right here, this solid line here. This is our support level, and this is actually a Fibonacci level as well. And traders
which one are we talking?
This one right here, the 98.73.
Oh, okay, got it. Yep.
This is a
black one, flat one.
It's a 38.2% retracement from the top. And so, but look at this wick on this candle. So you see how this wick came down and it touched that support, and then it's gone back, and then we're going to end hopefully with a green candle, right? So when we touch support like that, oftentimes this could trigger a reversal. It hits support and goes back up. Now, again, the data is super important. And if you look at this blue line right here, this is the 200-day moving average. And you can look back here, see how far above the 200-day moving average we were. Typically, the 200-day moving average when it comes to mortgage-backed securities is like a pretty solid level. And so the fact that we broke below that, not good. It's now going to act as a level of resistance on the way up. So now we're going to be kind of pinched between that Fibonacci level and this 200-day moving average. So it's not like a clean break. It's not like we have a lot of room to run here without having to battle some resistance. But it is interesting. It touched right. These Fibonacci levels are fascinating. It touched right on that, reversed, and now you can see where it's at right now. So this could be a bit of a reversal. We'll have to continue to watch the news and what happens. Now, here's what we do know, Anton, is that you look at the number of the equivalent of our Fed all around the world. They're cutting rates everywhere in the world.
Yes.
It's not just the Fed. And so, look, my long-term outlook has not changed as far as rates improving. Now, there's a lot of things that could happen that kind of black swan type events that we don't know. I think a lot of what we're seeing here, though, is due to the election. I think the volatility was because of that. And I think you're starting to see some trades that are in anticipation, accurate or not, just you can see activity that's anticipating that. And
you can see the markets making those forward bets again.
That's right. And it's not super bond friendly. And you're right. Some of the things, some people are predicting that if Trump's policies that he's talked about go into play, they could be inflationary. Now, there's the other side of that, which is the oil prices. Now, I've talked about this a lot on my podcast as well, is that you got to watch oil if you're watching mortgage rates, right? Because they do move very similar to one another. So on the other side of Trump's policies is this idea of somehow bringing down the price of oil significantly. If that were to happen, that would be de-inflationary. That would improve interest rates. So there's still, even if you go, okay, I'm totally, thinking that this Trump thing is going to go, it doesn't give us a super clear outlook on what the impact on rates is going to be. We still have to follow this data, but long term, it's still widely anticipated by all the experts in the mortgage industry that we see rates get better over time. The Fed's still going to keep cutting. They might slow a little bit. They're going to watch the data. They've said that. This is not going to be like a flip the switch and rates improve significantly overnight like many people were hoping or anticipating.
Yes.
But I still do think we are moving towards better rates. But look, things never move in a straight line, and if I were to zoom out on this chart and then we looked at it, in 3 months from now, it's probably just going to look like a dip, and then it continues on its way. So we got to keep in mind, sometimes you got to look at the forest through the trees. We're looking at the trees right now, and there is a bigger picture, and it should be better interest rates over time.
I think a couple things I want our listeners and everyone to pay attention to. One, the market is always like forward looking. Okay. 2, rates are still probably going to get better. But 3, not as quick as you want, not as quick as I want, not as quick as everyone wanted. So we thought this was going to be kind of a wham bam, it's done. Generally speaking, the Fed cuts over a year and a half. So, I mean, be prepared for this to go up and down over the next year and a half as we progress through it. Fourth, or the next item I think I want people to be thinking about, is a lot of this jobs data is reported based on the way our economy used to operate, and it doesn't take into account the gig economy, when people also work at Uber, when they're got one job and 3 side hustles. So when the jobs number shows it's weakening, it's probably slightly worse than historical unemployment numbers. And I think that's what the Fed was responding to when the market kind of said, hey, we think you're overcorrecting. Well, not the market, but some people said that. I think we're going to have to start measuring jobs differently. And I think that's why we're seeing these wild swings. What I want, or what I'm questioning, Tony, based on today, because we know it changes all the time. What do you think like the upper band is for rates in 2025? And what do you think the low band is? And then what do you think kind of the median prediction is? And I'm asking for yours and kind of what you think the market is.
Yeah, I mean, it's really hard to believe that the 10-year is going to go much above where it's at today. It's at 4.25 right now. And that's kind of my ceiling. If I had to say what, we knew that it was down in the 3s, and you thought, man, if it were to spike back up, what would be the top of that spike? Kind of 4.25 is my number. So, I'm really hoping that what we're seeing here in the charts is potentially a reversal. I mean, we don't have data to support that, but the technicals kind of support that. So I kind of feel like where we're at right now is kind of the top side of the market. 4.5, I could go another quarter on the 10-year, maybe much above that. I just don't see that happening. So,
and then explain the 10-year and 30-year fixed debt, so just all of our listeners are on the same page.
Well, they're different. I mean, I use the 10-year because it's what everyone talks about. And when we think about bonds getting worse, it's easy to go, okay, well, the 10-year, has some pretty strong fundamentals and we know where it's going to go. The two don't really correlate together. You got to think about a mortgage-backed security is a 30-year, it's a 30-year bond. 10-year is a 10-year note, right? These are fixed asset. You know how much you're going to get on your return. The problem with the mortgage-backed security is it doesn't trade like a 30-year because they don't last for 30 years. You can't. They say they're for 30 years, but raise your hand if you've had your mortgage for 30 years and just paid it off. Not many people. And so these really trade more like a 10-year. Really, if you want to look at the data, it's more like a 5-year kind of a term. So the 10-year is still a good benchmark, even though it's a different asset class than a mortgage-backed security. But the duration of it is kind of in there. So you can't really think of a 30-year as a true 30-year maturity because of the way they operate. You really got to look more like at the 5 and the 10-year. So I guess what I'm saying is I didn't really benchmark. And here's the other problem. You look at that chart I was showing you the 5.5 coupon of the MBS. I mean, there's different coupons that money goes into, and the charts would look very different. So it's harder to kind of pick a spot to say it's not going to go above this because you got to, well, which coupon are you looking at, so on and so forth. The 10 years more basic and easier to speak in those terms. So that's kind of why we use that. But I would say rates, rates are probably touching 7 right now. I would imagine. I mean, there's a lot of factors obviously that go into a mortgage rate. Down payment, credit score, occupancy, is it a condo, property type, all sorts of different things. But let's say that they're around 7. Where do I think rates could go in 2025? I wouldn't be surprised to see rates in the mid 5s during 2025. That's kind of my thought. Now, when does that happen? I think there's a lot of factors that will depend on that. But, we got down to the low 6s. I think that could happen. That could happen by the end of the year, depending on what happens as things settle down from the craziness of the election. And we kind of get back on track to where we were before the Fed rate hike. We were probably just above 6%. So, and then we think the Fed's going to cut next year. We should see the Fed benchmark rate about 1.5 lower than it is today. So you just think about the normal spread between mortgages and the Fed funds rate, and that would tell me 5.5 isn't a crazy number to look at for next year. Again, look, COVID happened and rates went to two something. So things can happen. Wars can happen. There can be wars can escalate. They're already kind of in place. They could de-escalate. We could see inflation start to come back potentially. That's really going to scare the market a lot if we start seeing inflation trends going the other direction. And it's not completely off the table that could happen. So there's just a lot of factors. Unfortunately, if I could predict this stuff, I'd be a billionaire and I wouldn't be probably working a day job. But that's kind of my take. I think it's realistic to think that rates get back into the mid fives if things kind of fall the way that they're expected to.
So that's kind of, let's call it the median is mid fives. What would cause it to go lower? And then what do you think the lower bound is? Not a black swan, but just a lower bound. And then what would an upper bound, and what would cause both of those, just so people can kind of mentally picture, what this looks like for 2025?
I think it'd be hard for rates to get a lot lower than that without some Fed intervention. They and the Fed's made it pretty clear that they don't want the super loose monetary policy of years past. Traders didn't like hearing that. That's part of the reason why you saw the 50 basis point cut. They made some comments in there like, are we going to zero? Like people thought that was like the first step to zero. He's like, we're not going to zero. We're going to get to a neutral monetary policy and we're going to stay there. And that's a different message than the Fed has given off in the past. So honestly, Anton, I think for rates to get below the fives, I think there's got to be some intervention. And I think you only get that intervention if there is some sort of a black swan type of an event. Sense. You need the Fed buying mortgage-backed securities. You need them buying treasuries. They need to become a buyer instead of a seller. But if left to just the market on its own, if the stock market takes off and runs like they think, and it's competing for those dollars that would otherwise be in the bond market, we're not going to see a significant dip in rates just based on economic data, in my opinion.
I love it. And then what's the upper bound? So inflation, so 5.5?
If inflation starts showing up again, and I think that's the only thing that could do it. And but again, I still think you would see some reaction by the Fed. Whether they raised rates again, I mean, believe me, he would if he thought he needed to. He's made it very clear we're not going to let inflation come back. So I think the only thing that gets rates to go above my prediction there is we start seeing inflationary data that shows it's going the other direction, and the Fed again has to step in. I think without any Fed intervention and things kind of going as planned, I think you do see rates come down over time, regardless of who takes the presidency, because the same pressures that we had that led to rates being as high as they are, many of them have corrected. Many of them were still legacy impacts that we were dealing with from COVID, and some of those things still kind of working their way through the system. So that's kind of my take on it.
I love it. And what do you think so rates fundamentally will probably be slightly lower, not as low as we want. What does that do for buyers, sellers, investors, lenders? Let's close on that thought there.
I think the market's gotten used to rates where they are. So even small improvements. I mean, you look at how much, our pipelines built up in the mortgage business just, right before the Fed rate cut when rates were kind of at their lowest, and they were still in the sixes, low sixes. We saw a lot more activity. So even small improvements are going to drive some activity. I think you get back into that range, and maybe even, as you start getting into the fives, you're going to see a lot more refinance activity. And that'll be good. That'll free up capital for a lot of people. You'll see some more debt consolidation, some things like that. But look, we have an undersupply of houses in this country, and the demand there is for housing. If the rates we had in the past, because believe me, we're nowhere close to the top as far as rates go right now, right? So if we continued to see demand despite how high rates were in the past, I do not see new home builds fast enough in order to sop up the issue we have here with housing in this country. So there's going to continue to be strong demand for housing, is what I expect. And we've already seen, I believe, the worst of the rates. If you think back to when we were almost at 8% rates and people were still buying, values were still going up. So yeah, I think it calms down. We're seeing pockets around the country where houses are flat, if not slightly soft in certain markets. But no, I think that demand stays high because there's not enough houses for people, and even if rates stay where they are today or get a little bit lower, I now, what I don't think you'll see is a resurgence of people back into the mortgage and real estate industries, right? Yeah. I think that there's been a lot of people that have gotten out of our industries. I don't know what the numbers are on your side, but on our side, about
it's worse on your side.
Yeah, I mean, so I don't think they come rushing back, which is, for those of us here, it's a good thing, right? Those of us that are still in it. But yeah, I think you continue to, it just gets better from here over time. But, it's the winter months. We're moving into, the winter months. It's typically slower in our industries during that time. I don't think we're going to get a ton of help quickly from interest rates, but we will get help over time. And I think that we got to get through this election and get back and see what kind of normal looks like before we have any strong predictions on really what is actually going to transpire in 2025.
I love it. Kind of just to cap this off in summary is, one, rates are not going to go as low as consumers, investors, real estate brokers, mortgage brokers want them to, as fast as we want them to. The Fed is going to cut a little bit slower, probably over the next year and a half. Rates probably somewhere in the mid fives. And as rates come down, realize what that does is that increases buyer demand, just traditional home buying side and also on the investor side. And so the thing that I want everyone also to be paying attention to is when there is this fear, this uncertainty, this doubt in the market, it is also deal season. So for the marginal buyer, it's time to go buy something. We just got a buyer literally 2 days ago, Tony. $25,000 in credits to the buyer to buy down the rate and part closing costs. The buyer's happy as a clam, seller's happy, so you can negotiate a little bit more right now. As an investor, you should be making offers. As a home seller, you might want to think about waiting for the spring for the certainty and doubt to go away, unless you're then the buyer on the other side. I can tell you the spring of 2025 is going to be busier than 2024. And we went through and looked at some market predictions. The Seattle Metro over the last 10 years on a trend line, 8.5% every year. So if it just continues next year, expect every home to be 8.5% more. That's a huge number. Yeah. So I would say, don't wait. Unless you want to fight the machine, even though it doesn't feel comfortable right now, there's some deals, but there is better rates coming. Any final thoughts from you, Tony?
Nope. I got to get to my next meeting. I'm glad we jumped on here really quick and did this. I hope it was what was helpful. And here's the thing about this sort of information is we're gonna have to do this again because
yes,
it is so market dependent. I love giving updates to people. Everyone wants a prediction. I don't mind putting myself out there a little bit, making my predictions. But the reality is that, it's data driven. So we will need to circle back and check in, and I'll make myself available if you ever want to do that, Anton.
I love it. Let's do it again, brother, man. I appreciate you.